All right, ladies and gentlemen, welcome to MacroAce with your host Tony. Going through FOMC prep, we have a lot to get through. We have what are the expectations for today? So we have the summary of economic projections, the rate statement as well, and of course the expected 50 basis point hike from the Federal Reserve. Key thing being is we are going to be seeing what kind of comments we get through from the Federal Reserve, which could rock the market in one way or the other, despite there being a pricing in already of a 50 basis point hike. Hello everyone. Hello Rohit. Hello Gabriel. Hello Dragan. Hello everyone. All right. So yes, don't forget to like and share this video and subscribe to the channel as well. It helps us a lot to get the word out there. Do let me know if you have any issues with the stream. And I'll try and sort it out as best as I can. But hopefully you can all hear me nice and clearly. If you cannot, do let me know and I will get that sorted. But first, let's go through what we have so far for now. So FOMC, what is it? So it's where the... So what is the FOMC? So it's when the Federal Reserve meets roughly every 6 weeks over 2 days. And they decide where to set the interest rate or the federal funds rate or the target rate, and then discuss any potential future options as to what they could do with monetary policy, provide forward guidance, like we're gonna get today with the summary of economic projections. To a degree, they're not explicitly giving forward guidance saying they're going to do this and this and this. They're just going to say, where they see, the federal funds target, PCE, inflation, where they see GDP and the unemployment rate. All those things are going to be combined alongside the monetary policy statement as to why they had taken those steps. So that's what happens. That's what's going to happen in this meeting. That doesn't always happen where you get the summary of economic projections in one meeting, or the SEP. So it is very interesting. It will be very interesting to see where they see the economy and rates. So again, the rate is also what banks charge each other to borrow or lend excess reserves overnight as well. But enough of that. Why else is it important? So of course it causes volatile moves in the markets and affects the wider economy. If you haven't seen how the markets have reacted to a rate decision before if you've never traded an interest rate decision, then this is going to be a very interesting intro to that there. But that's the key thing. It causes volatile moves in the markets, and it can also influence what other central banks do with their rate hiking path. Of course, don't forget, we have the Federal Reserve. We have not only the Federal Reserve today, but we have the Bank of England, we have the ECB as well tomorrow, and that is going to be a big stream I'll be doing tomorrow in the morning as well. So what else do we need to be aware of? So how does it affect the markets, right? Whenever interest rates are raised, that boosts the valuation of the currency, or if from the statement there's an inclination to raise further or by a stronger amount in the future, that can also cause the currency or the dollar, in this case, to appreciate much further. For stocks, whenever interest rates have been raised, that has been a negative for stocks, because whenever you raise interest rates, those businesses will have to pay more to borrow. And if you're paying more to borrow to provide the same amount of services or provide the same amount of goods to your customers or to the economy, that means you're going to take a harder hit. So that's one thing. Again, also, one of the reasons why the Federal Reserve will take the decision to hike in an aggressive manner, as we've seen in the past, is to dampen inflationary expectations. And that will have a huge effect and has had a knock-on effect on the stock market as a whole. So, and then bonds. So with investors, they might flee long-term bonds if rates rise. It could confirm that inflation is on the rise, and they may instead chase the shorter-term securities. Of course, the shorter-term securities have more of a sensitivity to the interest rate hikes, because that's where the Federal Reserve has most of the power and the play in influencing those areas compared to the longer term bonds. So you tend to see more volatility in the shorter term rates compared to the longer term rates. And we can see that from the deviations. If you'd sign up to MacroAce, that is completely free. How the markets react to certain economic releases, and today, of course, the rate decision. But it was also another thing as well, is that as the sale of bonds accelerates, their yields start to rise as well. Once investors grow confident that monetary policy is working and inflation appears steady, then they tend to switch to buying bonds again to lock in the highest yields possible. So where is the economy at the moment now? Another very important thing to understand: what is the Federal Reserve seeing, and how is that going to influence their rate decision today as well? So GDP, you had the third quarter second estimate at 2.9% versus the second quarter of minus 0.6%. Inflation, as we had seen yesterday, of course, if you were trading that live with me, the CPI report came in at 7.1% compared to the prior of 7.7%. So a nice drawdown in the inflation figure there for the CPI year on year. A PC price index was also lower as well at 6% versus 6.3% as a prior. Consumer spending at 0.8% versus 0.6%. Non-farm payrolls were still strong. It came in at 263k compared to the prior of 261k. So not really seeing a huge amount of job losses occurring or a huge amount of jobs being added to the economy. More of a steady jobs figures is what we're getting from the US. ISM manufacturing PMI came in at 49 compared to the prior of 50.2. A University of Michigan sentiment final was also at 56.8 versus 54.7. And the one-year inflation at 4.9 versus 5.1. And the 5-year unchanged at 3%. So these economic indicators more or less give an overview of where the US economy is, how strong it is, how where are the inflationary pressures arising from, particularly if you're looking at, of course, non-farm payrolls and the manufacturing PMI data, and what do consumers feel about, what is their sentiment with inflation? Do they feel that inflation in a year's time is going to be higher than they previously thought, or lower? That's also something that's going to be that's factored in to a degree with the sentiment stuff within the Federal Reserve's rate decision. So this is the previous rate decision. This is the rate statement that we had. So the key point, and this is what caused the dollar to move towards the downside, and we had seen the weakness in the dollar, is because the committee had actually said that they will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation and economic and financial developments. So besides, previously we hadn't really seen the Federal Reserve opening up that much with more of a dovish statement compared to what we'd seen in the past, of talking of continuing tightening. There is a need to control inflation, talking about whether or not there might be, will or maybe a soft landing or not, and kind of discussing those within Fed's Powell's press conference. But this is what we need to understand here, is that the committee has taken that, what you could say, that pivot, right, towards slowing down with their rate hiking path and kind of seeing what the current hiking path of the 475 basis point hikes in a row has actually done to the economy. Remember, with all these rate hikes that occur, it takes about a year or so for these to take effect on the economy. So there's quite a bit of a little bit of waiting that is kind of needs to be done by the Federal Reserve. But in order to do that correctly or in the right way, in their eyes, is kind of what is expected is to step down from a 75 basis point hike to a 50 basis point hike. And we've seen that with how the stock markets have reacted in trying to price it in, and how the dollar has also seen a loss in buying positions over the recent weeks as well, since we had the last FOMC rate decision. But again, it's a clear thing that the Federal Reserve is switching their narrative towards, we've done. We still need to hike, but we will also keep an eye on how that's affecting the economy, and then kind of take the direction or the lead from how the economy is performing to what they'll do with their rate hiking path. So then, Powell, it's essentially saying it's time to ease off the brakes is what was taken from the last FOMC statement. So on November 2nd, he said that it's difficult to see a soft landing as interest rates rise. The time to slow the pace of rate hikes could be as soon as the December or February meeting. So that's what really started to kick the dollar in the teeth a bit more, is that they could decelerate as soon as, of course, today or at the February meeting. And he did say that we will have a discussion on that at the next meeting, but no decision had been made yet. More or less, just kind of saying they probably will do. Probably will go with a 50. But, of course, remember, they are data dependent as well now, is what they've said. They're not really providing a lot of forward guidance with where they see the economy within the rate statements that we've seen in the past, or much of the press conference as well. But this is more of kind of like a big blinking alert, or like a alert, December 50 basis point hike, kind of a tannoy shouting over a microphone of what the next rate could be, or when the slowdown in the rate hiking path could be. Somebody said, when does it start? So the interest rate is at 2 p.m. Eastern time. We've got a lot of prep to go through, and that's, of course, going to take probably about an hour or so. There's a lot that's happened. I'm going to try and be as concise as I can with you guys. Also, Powell said that the ultimate level rates will be higher than previously expected. So then the markets flipped. So the dollar actually strengthened, and the S&P 500 or the stock indexes started to weaken, is because there was the expectation, yes, to raise rates to a restrictive level, but there was the expectation that the Federal Reserve could start to slow down the rate of their hiking path, but also pause at a smaller rate. Now this kind of flipped it and said, well, yeah, we're gonna probably take a slower rate hiking path, but we're probably gonna need to raise rates for a lot longer than we had expected or anticipated compared to the beginning of the rate hiking path. So this is the market reaction. So you'd seen the dollar that went back up, and the S&P 500 had seen that decline there off of that comment. Okay, so again, just making it nice and clear there for you, easier to understand. So November 3rd, you had the meeting minutes. The minutes from the 1st or 2nd November showed that a substantial majority of participants thought a slowing in the pace of interest rate hikes would be appropriate soon. So remember, the meeting minutes are from, of course, as I said, the November 1st and 2nd policy meeting. So it's not new. It's just showing you what they discussed, basically. And then the rate statement in the FOMC rate decision is just what they've come up with, or what they've agreed to. And that's quite a short paragraph. It was one page, by the way, the rate statement. The summary of economic projections is where the money was where the money and the honey is for traders and economists alike. They also mentioned that many participants expressed significant uncertainty about the ultimate level of the Fed funds rate required to contain inflation, with various participants suggesting it was higher than previously anticipated. Our participants agreed that there were few signs of inflation pressures easing. And then post the meeting minutes, so this is how the markets had reacted, right? What were the rate futures doing? How do they kind of take that into account? So according to FedWatch, you had US rate futures that slightly raised the chance of a 50 basis point hike to 79% in December meeting after the Fed minutes. And then you also had rate futures in the United States anticipate a terminal rate of 5.03% in the June Fed meeting. Keep that in your mind for now. That's going to be an important figure. Okay, 5% in the June Fed meeting is where they rate futures anticipate the terminal rate, 5%. Keep that in your mind, okay? Then, Fed voting members, what have they said post the FOMC and up until now? Of course, this week was you had a blackout week last week, and no one's speaking this week. Powell said the time slow pace of rate hikes could come as soon as the December meeting. Again, he dropped the hint saying it could be December or February at the FOMC press conference, and now it's just sticking to the December meeting. Okay, basically saying it's going to happen at the December meeting. So this is how the markets reacted. The DXY and the US 10-year yield weakened. The S&P 500 strengthened. Okay, again, when the Federal Reserve drops, or when Powell, the chair, drops these big hints, markets are going to take it, they're going to lap it up, and they're going to run with the ball, and that's what's going to happen. They're going to start pricing it in for a smaller rate hike, okay, or a depreciation in the aggressiveness of the Federal Reserve, okay, more of a risk-on reaction takes place. That, yeah, we don't need to be that aggressive with our rate hikes. We don't need to go that crazy. So that's what's happened there. He also added that economic activity growth has slowed to well below the longer run trend, and this must be maintained. The October inflation data was a welcome surprise, but it will require much more evidence to give reassurance that inflation is actually dropping. Of course, we had the inflation data yesterday for the November data, so that's another welcome sign for the Federal Reserve. November 28th, Brainard said that probably soon would be appropriate to switch to a slower pace of increases, and that she expects the retail margins to decline, contributing to disinflation. So retail sales, a thing about people buying goods and also services too, right? Partly, some of that is services and retail. It's more just restaurants within the retail area, if you're thinking about physical goods. But still, again, expecting inflation to decline in that area. Williams said that the Fed could reduce rates in 2024. Again, keep that figure in your mind as well. So you've got the 5% terminal rate in June 2023. Okay. The second figure is reducing rates in 2024. I hope I'm not overloading you guys with too much. I'm kind of like a mad scientist when it comes to this stuff. It's just go, pew, pew. There's so much to remember. Hopefully you guys are enjoying this too. Don't forget, share the video. We got, get it out there. If you like, also don't forget to give it a like too. If you haven't given it a like already. All right. Fed semester says, I don't believe the Fed is close to a pause on tightening. Bullard adding a recession is not inevitable. Collins said that 75 base point remains on the table. And then he also had other members too, Fed's bar, when asked about December Fed meeting, that it makes sense to raise by 50 basis points and it makes sense to slow the pace. You also had Bowman. However, it is necessary for us to slow the rate of increases, and that will allow us to do more. Allow us to more fully assess the impact of our actions. Williams also added that I am seeing forward indicators that inflation is turning. Fed's George, according to the Wall Street Journal, said the Fed should slow down the pace of rate increases. Cook, it is prudent for the Fed to take smaller steps as it moves forward. Waller, the higher the policy rate, the stronger the case for slowing rate hikes to 50 basis points instead. It makes me nervous that businesses are factoring a lot of wage growth, which will keep inflation high. So what he's talking about there is that businesses, you have consumers and people that are looking for a higher wage to offset the inflation that they're dealing with throughout their daily lives. And that could be a worry for the rest of the economy, that will, if you're being paid more, you have a lot more money, you have more money in your pocket to spend on the goods that you need to spend on. Maybe not necessarily the goods that you want, but on the essentials. And that's a definite thing that arises from being paid more within this high inflation environment. Of course, remember, we're only at 7.1%. We're nowhere near the Fed's 2% target yet. Non-voting members. Told you there's a lot. Fed's Evans says that even with smaller rate hikes, there is ample room to tighten monetary policy. And then Daly said that if inflation data does not cool, the Fed may raise rates beyond 5%. Bostic expecting a 0.75 to 1 percentage point more of tightening to be sufficient to control inflation. And he's also ready to move away from 0.75% increases at the December meeting. Fed's Loken said that the October CPI data is a welcome relief, but there is a very long way to go. Barkin, I support a slower, longer, and potentially higher rate path. Kashkari says that I hope projections that inflation will drop in 2023 are correct. If they are, I would imagine we will stop raising rates next year. Harker said that we may pause as long as we are continually working to reduce inflation. And there's a lot of comments here. Somebody's looking for 75. People are talking about should they short. Somebody says 75. Let's go. You guys are crazy. All right. You never know. Might be a surprise. Let's carry on. So this is the previous summary of economic projections that we had from the Federal Reserve at the September meeting. Okay. So the key thing you need to note is that where do they see the federal funds target, or the federal funds rate? So in 2023 at 4.6%, and then in 2024 you actually see a reduction in that to 3.9%. So somewhere within 2023 to towards 2024, you're expecting, or according to their estimates, a rate cut at that point. And then, of course, going to 2.9% in 2025. So that's what going to be another thing that's going to be interesting is if we get a revision or a very big revision to where they expect the federal funds target. Let's say that they expect a smaller rate in 2024, okay, or in 2023, right? We're going to hit 4.5% today anyway. Or if we do get a 4.75, surprise the markets, everyone. So if we do get a smaller rate in 2024, maybe that means that, they've started to cut a lot sooner in 2023 to get to that range or to get to that figure. That's one thing to be aware of or do we see a huge upward revision in the federal funds target rate? And actually, maybe this figure is going to be higher than it was in the September economic projections or summary of economic projections. That's going to be a scenario that could flip the market either way. Now, if we do see as a potential scenario, if we do see a higher revision to the federal funds rates estimates, that could mean that stocks could take a hit if they're expecting the Fed to go to a higher amount. Doesn't matter whether they're going by a 50 basis point hike or not. It depends on how much hiking how long are they going to hike for. So what you're going to be trying to look for is how long are they going to be hiking for, right? Do we see a huge upward revision to the 2024 federal funds target and the 2023 target as well? Or do we see the flip side, or do we see a smaller target range being presented? Okay. The PC inflation data is also going to be, it is important to see how long they, where they see inflation further down the line. But we have seen in the past when, the Federal Reserve or central bank is nowhere near the 2% inflation target or the inflation target, that they'll start to pause much sooner, and then they will cut later on down the line. So although, yes, that is going to be important if they do show an upwardly revision, I'm sure they might change it in light of yesterday's data from CPI. But of course, this is the PC price index. Okay, so that CPI could have an influence on the economic projections, but the PC price index anyway has been going down. So you could see a revision to this, to a lower revision, where they expect the GDP data is also going to be important too. Do they expect a soft landing within the US economy later on, or do they envision more of a hard landing, which could rock the boat a bit more with the GDP figures for 2023 and 4 and 5 as well. And that's going to be important through the comments that we get from the Federal Reserve too. But again, this is the September summary of economic projections here. Then there's an interesting piece. So on the New York Fed's website, you get an insight into primary dealers' points of view, or survey primary dealers. Okay, who are primary dealers? You're thinking about your big boys, your investment banks, right? Goldman Sachs, JP Morgan, those big boys, right? Those are the primary dealers, and they ask them of their expectations of where they see the Fed funds target, where they see the economy, GDP wise or PC inflation. All of that is included in one survey. So one thing I wanted to highlight, and this is done, the data was compiled before the previous rate decision that we had back in, this was compiled, it was actually, all the data was put in on October 24th all together. So they would have taken data from, the immediately following the September rate decision that had occurred. But this is one thing to be aware of. So you see here, so you have the percentile figures, right? What is the median range? What is the median expectation? What is the high and what is the low range? Okay, so if we're going off of the median, right? If we're seeing that these economists or these big boys, these primary dealers, are expecting the rates in the mid range of the rate to be at 4.37%. Again, that more or less that's 4.5% in December. Then you're looking at, when is the Federal Reserve actually going to pause with their rate hiking path? Okay, in this area here. So the median estimate, if we're looking at it, is in the March meeting, according to these primary dealers, is what they expect out of the 25 respondents, right? Pausing basically 5% is what, or at or around 5% in that target range of it would be the Fed funds target range of 4.5 to 5%. Okay, that would be the target range, and this would be like the midpoint. Then in the 75th percentile, or the high end of that estimation, you're actually seeing a slightly or much higher rate here, right? 5.125%, but then a pause in February and January. So the scenario is you hike by a big amount quickly, get to that range where you want to, and then you pause, and then you take a smaller pause. And then you take a pause sooner rather than later. Or you kind of go a little bit higher, just a little bit higher, and then kind of just pause and let the economy, we'll see how the economy reacts. So when could there be a cut? Right, what's that scenario? So if we're looking at the quarterly data of what the expectations are, 2023 Q4, or the fourth quarter 2023. Within that quarter, or actually, if we're going from 2023 Q3 to 2023 Q4, it's kind of giving a scenario that something could happen after the third quarter of 2023 with what the primary dealers are expecting. Who said rates are irrelevant? No, they're not. Yeah, asset prices are high, but everyone's going to be focused on where they expect the rates to go. How long are they going to raise rates for? is the key thing here. I think, yeah. Just remember that. Okay. So there we go. So when would a rate cut could a rate cut occur? Between third quarter 2023, fourth quarter 2023 as a high or as a high end. Or then you're looking at, if you're looking at the median estimate, again, similar thing here too, as well, Q4 2023, or between that time. And the low end, you're actually looking at the 25th percentile of the respondents. You're actually looking at Q4 Q1 of 2024. That's also another thing too. So that's just something that I just wanted to show you, which I found interesting. Of course, this is usually this stuff can be. I kind of tried to match it up to what the last summary of economic projections had done as well. And it's quite interesting to see and to try and understand. So that's that. We've got about 30 minutes. Whew. Okay, I'm nearly there. So investment bank views then, right? No, I have not discussed. Shant Jane says, "Hey Tony, just joined. Did you discuss the dots already?" No, I have not. But we have talked about the Fed expectations. I've got a lot to kind of go through, so I put that to the side for now. So in Goldman Sachs, CEO Solomon warned about wage and employment losses, predicting some rocky times ahead. Bank of America reducing the hiring as fewer people depart ahead of a potential economic downturn, according to their CEO Moynihan. Morgan Stanley starting a new round of layoffs with Jamie Dimon of JP Morgan JP Morgan told CNN that a moderate hard recession might hit next year. So there is this expectation that the Federal Reserve's rate hikes is going to have an impact on the economy if it hasn't already now, or a huge impact now. It could have a much bigger impact later on. Wells Fargo expect the Fed to raise their Fed funds rate to a peak of 5.25% by March 2023. You'll notice that kind of sits in line with the data here, where they kind of expect the Fed funds or the Fed funds rate, federal funds rate to be between January to February or in March. If we go back, Bank of America expect the Fed to raise its target range for the federal funds rate by 50 basis points in December to 4.5%, and that's just the range, 4.25 to 4.5%. I said that last time. So the other range would have, in the previous slide would have been 4.75 to 5%, or 4.5 to 5%. That doesn't work like that. They go up in increments. The target ranges by 25 basis points each. Also adding, the Fed communication of the last few weeks have clearly telegraphed this move, and the more important question is where the Fed goes next. Dots are to shift higher again, as well as what they expect, and they expect median forecast for 2023 to move up by 50 basis points to 5.125%, consistent with their terminal rate. I think the dot plot will then point to 100 basis point of cuts each in 2024 and 2025. So again, going back, kind of similar to what we see. You could see that happening here, right? We're looking at the 75th percentile. That scenario is kind of being presented there within the median and the 75th percentile data there. Market pricing as well. So as said, post a weaker CPI figures that we had yesterday, Fed swaps downgraded their peak policy. So I hope you kept that figure in your head of the 5% in June 2023. Now they downgraded their peak policy rate to 4.88% in May 2023. So to 5%. Or a smaller amount in May 2023. So that's also another key thing to remember as well. So that's what the market's been pricing in, with the stocks moving higher. You've had the dollar taking a hit and a tumble of this pricing in for a 50 basis point hike, and the expectation to slow down with the Fed funds target range. That's what the market pricing in. That's what the market is pricing in at the moment. Now, the previous rate decision, we are nearly there. We've got plenty of time. Kind of mute my voice there. So, what had happened is when the rate had come out, this is about 4 seconds before the prior release that we had. Okay, so you had the data that had come out from the rate decision, and then if you kind of skip ahead. So actually, you know what happened to our website? Our website, now the issue has been resolved. Hallelujah, devs. The issue has now been resolved. So if anyone was watching the live stream then and thinking, wait a minute, where's the figure? Well, because there were so many people and we were so popular, right? So many people were making a connection to the FinancialJuice website, because they wanted to get the good data, right? And their stream, and their news. It actually crashed the site. So that issue should now be fixed. So that shouldn't be an issue. But you can see that what happened is that the S&P 500 and stock market had appreciated. The dollar had seen a weakness off of the back of that rate decision. It was because of the comments that were made of expecting a slower rate hiking path for the future. And then Powell kind of helped surge that a little bit, helped that push a little bit more within the stock market until he said maybe, but actually we might be hiking for longer than we had originally anticipated. So that's what happened in the markets. Okay, so when you're trading the release, yes, the figure is going to matter. Of course, it's important, but it's the deviation. Do we get a 75? Do we get a 25 base point hike? Which sounds crazy, right? If I said, if somebody said, yeah, there's going to be 25 base point hike today, that's nuts, right? But hey, anything is a possibility. You never know. The Bank of Canada has also did it as well in the past. The people were expecting a 75 base point hike, and everyone, actually, they delivered a 50 base point hike at one of their meetings. Morphbot says 100. Hell yeah, baby. Tied it even further. So you can see there the comments kind of came through as well. So the Fed, in determining the pace of rate hikes, they'll consider cumulative tightening policy lags and economic and financial developments. That comment really set off the market rallying instead. So that was the dollar yen. Took a nice old hit. Now, here is the juicy bit. I'm going to pause this video. Let's get out of here. Get out of there. Now we're going to go to our deviations. Deviations. So what are the deviations? Okay, what is all this? Tony, what are you showing me? Well, what I'm showing you is how the market reacted to the economic release, and then what the sentiment was for that release as well. So the rate came in as expected. You had the stocks going up, at the dollar taking a hit. Okay. So what else? So what was the sentiment? Why did the markets move by that much? The sentiment is that there was a less hawkish Fed and the rate was as expected, and traders are now pricing in a 50 base point hike as the most likely Fed move. Okay, because of what? Because of the Fed being more cautious in their view with the rate hiking path, and not being very aggressive with their language of saying we need to get inflation down, we will do what's needed. Now they're saying we need to get inflation down, but we'll take a sip of Kool-Aid and we'll kind of see what's going on, right? So that's basically what happened. Now, what do we need to know today? Okay, what do you guys need to know is deviations as what had the biggest market reaction? Okay, so like I said, the shorter term rates have historically seen a bigger market reaction. So the bond price on the 2-year had seen about 25 ticks towards the upside. Just to kind of explain what these figures mean and what the brackets mean. So the first figure here shows you the initial market reaction, capturing the move all the way to the wick. Right, it's important to understand how volatile the release is. So that's what I like to capture all the way to the wick on the first candle. And then in the brackets represents the move 10 minutes post the release. That doesn't go to the wick of the candle. You've already had the nice juicy move at the beginning most of the time, and after about 10 minutes, then I just go to the end of the candle for the. Sorry, I'm listening into FinancialJuice. So there's a bit of upside movement in stocks and downside movement in the dollars in anticipation of the Fed. Oof, things are heating up. But that's what it measures here. So you can see here on the S&P, it's seen 103 ticks towards the upside, and after about 10 minutes of trading, it was still up by about 131. The Nasdaq had seen not the biggest, not as big as a reaction compared to the last one on the 1st of September, because of course that was when we had the summary of economic projections as well. So that added to the sentiment there. But then here you'd seen 478 ticks towards the upside, and after about 10 minutes of trading, it was 499 ticks up. Gold about 69 ticks up as well, and after about 10 minutes of trading, it continued to pump higher, to 146 ticks after 10 minutes. So what is the biggest currency? Which currency reacts the most? It's the dollar yen, is what we've seen. In the past, it's been pretty consistent to a degree with being the biggest reactor within the markets. If you were looking at what had the second biggest reaction, it would be here, cable, right? It's seen 48.5 pips towards the upside. After about 10 minutes of trading, it was still up, and then it was up by 76.5 or 77 pips. So you have the dollar yen, cable, okay, and the euro dollar, which actually also had the dollar CAD, which had a decent move as well. The Aussie dollar also had a decent move too the last time round. Aussie dollar doesn't really have huge movements in the past compared to the big three currency pairs of the dollar of the dollar yen, euro dollar, and cable, but it had seen a nice reaction that round there. But historically, what we've seen is it's been between the dollar yen and cable, which have seen nice movements in the past. Right. So that is so what do we need to know? Okay, what do we need to expect from the Federal Reserve? So the interest rate comes in line as expected. Okay. If you don't really get a hawkish Federal Reserve or a dovish Federal Reserve, it's more or less what is kind of expected, or what's been said in the past, then you might not see that much of a huge market reaction to the release. Okay. You could, however, see a huge market reaction if let's say you get the rate in line as expected, but it's the sentiment too of the statement that's been released, and also the summary of economic projections. If we're presented with a more hawkish Federal Reserve about the future of the rate hiking path needing to go on for longer than expected, and giving higher figures for the projections for the federal funds rate, and also the PC inflation data too, that can actually cause a bigger amount of volatility, where you could see the dollar see a movement towards the upside if you do get a more hawkish Federal Reserve than expected. On the flip side, if you get a more dovish hawkish, if you get more of a dovish Federal Reserve with the rate coming in as expected, you could see the dollar actually moving down further and taking a bigger hit. And of course, if the summary of economic projections provides a smaller rates with the federal funds rate, okay, and PC inflation cooling sooner than had been previously anticipated, that could lead to the dollar seeing a bigger decline. Now, if there's a deviation with the rate, okay, if there is a deviation with the rate, if we get if we get a 75 basis point hike, right, everyone's pricing in for a 50, okay, everyone's looking for a slowdown in the Fed's hiking pace. With the 75, that would be the fifth 75 basis point hike in a row, and then actually there will be some problems. On top of that, if you've had the CPI data that was smaller or lower than expected, and the markets have been trying to price in for the Fed to slow down, and we do get a 75 basis point hike, something's gone wrong, is what you need to know. There's somewhere in the economy that the Federal Reserve is, with inflation or whatever it may be, there's some issue that the Federal Reserve has that they want to deal with, and that they want to stick with the 75 basis point hike, right? That would be a shocker. Either way, whenever you get a rate decision, you always see you always get bigger swings and more volatility when there's deviation in the interest rate. More likely, like we'd seen with the Bank of Canada and also the Bank of England back in 2021. If you do get a higher than expected rate of a 75 basis point hike, you could see the dollar seeing some strengthening, but it could be tempered by a dovish statement or SEP. Okay, so it could be a dovish hike is what we could see it as. Flip side, if you get a smaller rate decision than expected, if you get a 25 basis point hike, hallelujah, is what you'll be kind of calling out within the markets. But if they remain hawkish or very hawkish in the statement or SEP, that could temper how much the stock market goes up by. Okay, those are the potential scenarios that could occur. Does that make sense? I've said a lot. I haven't looked at the comments section a lot. I see people like trying to go with their expectations. Some are seeing a 75. Somebody said there's a data leak. Come on, man. We ain't doing a data leak again. I think the Federal Reserve is better defended this time. They're not going to take any risks with leaking out this stuff. Alex Mitz said makes no sense. Joking, makes a lot of sense. All Father Asia. Wow. Okay. So are you like Odin? So, being called the All Father, but you're the Ordina in Asia. I'm actually confused as hell. Lots of sense, mate. Says Sparrow. If we get Fed leak, then I'll take that. Dragon says I'll take that into account. Yeah, I hope they don't, because then that just causes a lot of unnecessary confusion. What else do we have in the comments? What else? Let me get the charts kind of nicely done. So what am I looking at today? So I'm looking at dollar yen, the S&P, and also 2-year bond price here as well. That's what I'm keeping an eye on. Yeah, you are the Odina of Asia is how I would say it. What else do we have? Somebody, I think Musa Sia said, assuming it is a 0.5 like expected, how do you think the market is going to react? Hopefully I answered your question there with the stream comms that I had. Scotch and stocks. Hey, you're back. Imagine if it was leaked that there was a 25 basis point cut. Yeah, or 50 basis point cut. Yeah, that'll be crazy. Robin Shu is saying 50 basis point, please, with your hands clapped together. Yeah, remember a lot of the market has priced this in. So dovish or hawkish Fed, or you want to see how dovish or hawkish that statement gets. Now we're going to be looking at FinancialJuice for the headlines and also the data in real time. Don't forget, so FinancialJuice Pro, what is it? If you've got FinancialJuice Lite, or you've never ever heard of a live voice and text service, or used live voice and text service before, what you need to understand is it provides you with up-to-date information of what's going on within the world. Okay, what's going to have a global macro effect on the markets. Okay, we're talking about the Fed. What? We're talking about prime ministers. What? We're talking about the president. What? We're talking about statements. What? We're talking about a lot of things. So that's kind of that goes on, right? That's provided. Why is the market moving in a certain way? Why is the dollar or the S&P 500 going up or down, right? There'll be headlines, you can kind of time it and understand what's going on. You also have your need to know market risk. So you have your live voice here. You have your stream of live text headlines that come through on the news feed. Your economic releases are also in real time as well, with the rates decision coming up. The other thing is that if you're on the light version, of course there's a delay to the website. If you're on the pro version, there is no delays, no adverts. all nice and crystal clear, and you only hear our voice and see the headlines that appear as well. William Riker said, "Did you guys have an Xmas party today? You seem extra merry." William, if you haven't watched my streams, you don't know who I am. Just to kind of let you know, I am always like this. So yeah, don't worry. As long as you find the information useful and you share and like the video too, that's what matters. So financial juice. So why do people use a voice service? You have investment banks that have access, to a live voice and text service because they want to either manage their risk or capitalize on potential trades from hearing a certain statement being said by the Fed. They want to know why the markets are moving in a certain direction. It's a big advantage for all traders to have access to. And it's something that's not readily available to the average retail investor or retail trader, I should say. Day traders particularly, right? That's where a lot of the moves happen. You can kind of capitalize on what's going on on the risk sentiment that's taken hold of the market, and we provide you. We're kind of like the boat, kind of steering you guys, or helping to steer you guys in the right direction with our text headlines and letting you know what's going on within the markets as well. So that's Financial Juice. Now, you can sign up to Financial Juice Pro, but what you need to do first, if you've never come across the Financial Juice website, if you don't have an account, make an account. Okay? I'd say that very aggressively. Apologies. I don't mean to be that aggressive. I'm just very excited. Gonna start slowing down the rate hiking path, hopefully. So first of all, what you need to do is to sign up to the Financial Juice website with certain newsfeed with your own account. That means having a username and an email address. Once you've signed up to the website and you're on, you will be on the light version. Then there'll be a button here that says Go Pro. Then you can go Pro, okay, and then you can pay for the full version. Once you've paid for the full version, you will have first of all, actually, when you sign up to Financial Juice, the website here, you will have an email to verify your account. Verify it, go back, then go pay for the pro version. Once you pay for the pro version, to, let's say, install the pro version on the website, because it'll still say the light version, you need to log out and then log back in to the website, and then you should have pro. Make sure you don't have any VPNs or ad blockers on the website, or crazy ad blockers on the website. That can affect the newsfeed and also the voice. It might not turn on or at all. And also just make sure you have your sound and notifications on the site on allow, okay, for this little thing there. And then you should be all good to go. So that's Financial Juice Pro, right? And let me get my TICKSTRIKE up and running. Now, once I'm getting my TICKSTRIKE up and running here, if you're familiar with TICKSTRIKE, if you're not, I'll go through it in a bit. But if you wanted the deviations for the economic release, right, in the future, and you want an understanding of what to kind of expect or how the markets have reacted to previous releases, then you can sign up to MacroAce. You can sign up to MacroAce completely free. I'm just going to put the link for Financial Juice. That should take you to the homepage. Okay, the link I've just popped in the pin. Remember, create an account, verify it. You can pay for Financial Juice if you want. Pay for the pro if you want to. Whenever you're ready, have a little play if you're not sure how to use, or if you've not really come across voice or text service, and then pay for the full version. So no pressure. Take your time. Whenever you're ready. If we're going back to how can you get access to the deviations, it's completely free. And on top of that, I provide you a mini rundown of what to expect within the Asia session, US, Europe session, a summary of the weekend news. You can also expect that too. It's not a big email, right? It's not filled like graphs and charts and all these big old figures that kind of come through, right? It's a short and sweet summary because a lot of the prep, a lot of the stuff that's that could be in an email is actually done through here in these live streams that I'm doing here with you guys. That's what the honey is. Okay. Okay. So, yes, we have Alex Smith says we have 5 minutes left. Yes, we have less than 5 minutes. All right. So, that is Macroace. Oh, sorry, I was looking at the comments there and also realizing we had about 5 minutes left. So, Microace, you can sign up for that. As I said, completely free. That is the link there in the chat for you to use as well. If you're also if you've come across unusual activity, so if you like trading unusual volume activity in stocks, crypto, forex, futures, and you can also sign up to our free beta test of our new service, Unusual Activity. Okay, and that as I said, is completely free. I can't put it up on my screen because I have so many things to look at the same time. It'd be a bit too much to kind of keep an eye on. But that's completely free. Really, we've actually made a new update, but your feedback is very, very welcome and needed for our products and Unusual Activity as a product and service itself. Ooh, my throat's kind of going there. But hey, we're nearly there. We've got about 4 minutes left till the rate decision. Kind of see. So on the microphone, who's going to be not this microphone, not me speaking to you now. On the FinancialJuice page, we have James, our head analyst for the US session, who is going to be delivering the interest rates for the Federal Reserve, and that's 3 minutes. 3 minutes. That we're going to be getting that rate decision data from him. So good luck to him. Good luck to you guys as well. Good luck to everyone. I hope it goes. Hope it does go okay. Right. Let's see. What are we getting here? Do we get a 50 or do we go to 75? Well, now, what I will do is when the rate comes out, I will pick through the headlines of what I see and then try and summarize the sentiment or why the market has moved in the way that it has moved. I need to get my S&P 500 up. Get my S&P. Yes, where are you? Don't run away. There we are. That's good. All right, there we go. S&P the other way. I'll tell you what, we'd also want the NQ. There we are. All set up. So, and got my 2-year bond, got my gold there as well, all set. All right. Got 2 minutes. Oh yeah, we've got about a minute left. One minute to go now. Less than a minute. Ooh, calm before the storm. Uh-oh, dollar's going down a bit. Let's kind of see bond prices. Let's actually get gold up too. All right. Okay, come in. 10 seconds. Let's see what happens. Do we get do we get the inevitable or the hike, 50 base point hike, 50 base point hike to 4.5% as expected. Seeing a movement towards the downside there. All right, so just taking a look then at what is causing the move in the markets and why is the S&P 500 going down? So, as said, they went with a 50 base point hike. It was unanimous. Job gains have been robust. Unemployment rate is low. And they also said that recent indicators point to modest growth in spending and production. Their view on the Fed funds rate at the end of 2023, 5.1% versus 4.6%. So there's an increase in that expectation there. There's been an upgrade to the end of 2025 rate as well, and also the end of 2024, keeping at 4.1% compared to 3.9%. That's what's causing the markets or the S&P 500 to go towards the downside. So more hawkish Federal Reserve being presented there. So apologies for anyone who is using the FinancialJuice website. Again, it is down to our users. So many people. If you're not able to see the data there is a lot of connections being made. Apologies for that there. But that is what's currently going on at the moment in this crazy environment. Okay, so just to summarize what had occurred there within the market. Oops. Just to kind of summarize what happened in the markets. So the expectation of higher rates in the future is what caused the markets to move towards the downside from what we had seen there within the market. So the expectation is again high expectation for federal funds rate in the future, and also the inflation data as well for the PC inflation. So you can see if we're looking at 2023, they see PC inflation at 3.1% compared to 2.8%. And only two policymakers project year-end Fed funds rate below 5%. So more or less, again, that's why we've seen the move towards the downside there. Okay, so let's do some measurements here. Right. So on the S&P 500, we've seen 134 ticks down. The dollar yen, what we got here, we had, how many pips did we get? So that was 88 pips move towards the upside. And there's what we'd seen on the dollar yen. So if we're comparing it to the last movement that we had, or data that we had, let's see. Okay, what do we got here? So yeah, the last movement that we had actually had a much bigger move this time around than it did last time around. So we'd seen about 69 ticks down on the dollar yen last time, and now we're seeing 88 or AAA. Hey, that's a good figure. That's a good luck figure. We had seen about 89 pips towards the upside here today. If we look at bond prices as well. Bond prices, also seeing, how many ticks do we get there? So there was 50 ticks towards the downside there. So remember, bond yields are going higher, bond prices going lower. Gold as well taking a hit there. Again, a more hawkish Federal Reserve. Just kind of clarify that to you guys as well. So gold 148 ticks down. For comparing it to last time, gold had seen 69 ticks up on the initial move, but this is, you've seen a much bigger move here on gold there. All right, so that was the market reaction. Again, if we're looking here, so yeah, again, you can clearly see that there is a upward revision of the Fed funds rate and where they are expected to be later on in the year. What else have we got? What else? We've got the dot plot plan. Well, All right, so that concludes that there with the Federal Reserve and the FOMC meeting minutes. Of course, at the bottom of the hour, we do get Fed's Powell as well, giving you his point of view with his views of why they've projected a higher rate path with the federal funds rate. And then what else does he see for the economy as well? So I'm trying to see. There isn't really anything about actually the Fed GDP. So actually, yeah, there's also a downgrade in GDP too for 2023 that you see it at 0.5% in 2023, previously seen at 1.2%. And again, a slight decrease there in the expectation for GDP, slightly higher expectation for inflation. So again, here we go. So how does the Fed influence other central banks? Bahrain, they increase their lending overnight 1 week and 1 month deposit rate by 50 basis points each. So again, so dollar seeing a move towards the upside there. Dwarfed everything else. All right, so don't forget to go through those links that are provided to you guys. If you've enjoyed this content, if you found it useful, don't forget to like, share the video, and subscribe to the channel as well. Tomorrow we're still not done yet, right? We are still not done yet. We have the Bank of England. We also have the ECB rate decision, right? And that's going to be a double whammy. So they're coming out together. So we'll just bring that. What I'm going to do is I'm going to share that link with you guys as well. Again, apologies if you were using FinancialJuice. Again, as said, there were a lot of people making a connection to the website, so that would have caused a delay in the figure. Again, apologies for that there. But let me copy the link here for you and bring that here for you. The link for tomorrow. There we go. That is for the Bank of England and the ECB interest rate decision. Both important. Both are also looking to decrease their hiking pace to 50 basis points from 75 basis points each. Remember, the Bank of England had only delivered a historic 75 basis point hike once. Of course, it was at their last meeting. So again, 50 basis point hike is what is expected for both of the central banks and their rate decisions. All right, thank you very much. Take care. Enjoy the press conference with Fed's Powell. Don't forget, he could also move the markets too, right? It happened last time when he said that rates could go higher, much higher than needed, much higher than thought. That could be a scenario. So, you could have some surprising comments coming from Fed's Powell too. Keep an eye on that. If you're subscribed, make sure, if you are using FinancialJuice, make sure you do have a free account. Make sure you do have an account first on the website. And then if you are ready, if you want to sign up to the pro version, then after you've verified your account on FinancialJuice from your email that you would have received from us, then you can go back after you've done that to click on the Go Pro button there, pay for it, log out, and then log back in with your username and email, username and password that you had created. Okay. All right. Thank you very much. You guys take care and have a lovely night. I'm going to rest my throat, my voice box. All right. Good night. Thank you very much again.